We are back. September's done, quarter 3 is done, and although we didn't earn more than quarter 1 or 2, I'm happy with September's performance to date. Some great payments from our bigger holdings which have managed to bolster the portfolio. We now only need approximately $226.73 per month to reach our $2,400 income goal, which is certainly more achievable than what we are looking at after the end of August. So let's crack into it and see what this month had to offer in terms of payments. ABR paid the third dividend of its quarterly payments to net us $70.72 for the month, which brings the total dividend income generated by the stock to $187.19, making it our portfolio's highest payer for this year thus far. Currently, it seems like you can't say enough good things about that performance. Since buying into the stock in March of 2022, I've been slowly increasing my position with any chance I can get. As you see, we've got a simple return of around 13.44%, which for my position transpons to an average return of $286.45. To date, we've been paid roughly $259.54, which is about a 7.3% dividend yield across the investment's lifetime. If you manage to buy into them around COVID, you'd be doing a lot better due to their 5-year low being at $4.06 compared to the current price being around $15.37, which represents a change of close to 280%. For the year thus far, ABR has generated a greater return than the S&P 500, trailing only slightly behind its 5-year annualized return. Actually, if you take the date of my investment into ABR and look at how a 10k investment into ABR versus SPY would have paired to one another, we can see that ABR would have outpaced the S&P 500 by a total return of nearly 20%. Everything looks great. Their revenue and EBITDA is growing at a faster rate year over year, and profit estimates say that it's currently 28.7% below its fair value, which I can see as reasonable considering its 5-year high was $20.73. However, as with everything, there are some areas you need to be concerned about the stock. As you can see, their return on equity has been decreasing with a year-over-year change of negative 19.1%. which indicates liabilities are starting to grow more than assets. More importantly though, in my mind, is the fact that their free cash flow yield has been decreased greatly from quarter 4 of 2022 to quarter 2 of 2023. That to me is a red flag. Admittedly, it's not as bad as it would have been if they didn't show promise elsewhere, but this decreasing figure is a ratio of ABR's expected free cash flow earnings per share to market value, which can be used to measure solvency. The higher the figure, the better it is for investors, as it shows the company is generating enough cash to pay for things such as debt or other obligations, like the dividends we know and love. The lower this figure, the worse it is, as it's showing investors are not getting a good return in exchange for the money invested. Tail onto this is the fact that their total debt is not presently at a manageable amount. According to Simply Wall Street, in quarter 3 of 2022, the debt to equity ratio was at 489.8%. It has since gone down to 399.2% in quarter 2 of 2023, but to me that's still up too high, as they could find themselves over-leveraged if financial markets end up worsening. Regardless of this, they must be confident that their high profits over the past year will continue, as they have consistently increased their dividend year over year. One thing I think they could benefit massively on is by reducing their earnings payout to shareholders, so more debt could be paid off and their outflows reduced. This is something I don't think shareholders would be too mad about, as it would bring them more security in the future. AGNC paid the portfolio $3.38, bringing the total now to a small $21.06 paid for the year. It's great to see their revenue increasing year over year, but even more so that their market capitalization over the last 4 quarters is starting to increase compared to its downward trend over the past 4 years, which shows that hopefully the micro change of its performance will continue to the macro level. Like I said, their earnings per share is a bit low due to the low yield curve being inverted on long-term versus short-term loans with current interest rates we've been seeing. I'll continue to reinvest the dividend here, as when the money market for loans recovers, this yield curve will switch and massively increase the profits for AGNC by making their short-term loans, which is the majority of their portfolio, more valuable in terms of the interest rates assigned to them. We then had another consistent dividend of 25 US cents per share from BST that netted us $2.25 for the month, which now puts the total paid by the stock at $17.03. In my opinion, it's a great time to buy the stock, as it is essentially only $3 off its 1-year low and $8 off its 5-year low, compared to being $4 off its 1-year high and $29 off its 5-year high. Tech is here to stay, but more importantly, the holdings it has, such as Microsoft and Apple, have cemented themselves as being leaders in the tech industry for years to come, meaning that profits, although never guaranteed, should be highly likely for a fund such as BST. The net asset value, when compared to their market price, shows us that they're on a very slight discount. Their NAV is currently $31.76 compared to the market price of $31.63. Not anything to write home about, but it's still better than nothing as far as discounts go. We were then paid $20.78 from CCI, which represents a third of its quarterly payments. Currently, CCI has earned the portfolio $56.73, and I expect by Q4 the stock should have earned us about $70. Since buying T-Mobile's business in March this year, they've been able to drive revenue up about 61.5%. Just unfortunately, this hasn't resulted in high profits due to outgoings in the form of interest payments, cutting into these profits massively. This company is still massively undervalued, which I feel like a lot of people are sleeping on. They've been consistently able to grow their dividends since 2016, which is a big green light for investors such as myself who put massive onus on growing dividends. The EPS is supposedly at 23.68, and their net profit margin is a whopper 167.10%. I think the future bodes well for CCI, as according to a study by LendingTree, it was shown that an average of 12.2% of households across America's 50 states still don't have internet. Another study done by the National Telecommunications and Information Administration Department of the US stated that in 2021, about 1 in 5 households is still not connected to the internet, which is something the current government administration wants to fix. Essentially, this just represents a massive share in the market that CCI could potentially capitalize on, which would seriously increase their revenue even more so. We were paid $6.05 by Ellington Financial, who now have a total of $44.18. According to company analysts, their book value is currently at $14.30. This now exceeds their share price of $12.93 and is beneficial to hear. This represents a difference of 10.6%. It's great for those either looking to buy into the fund or those who have already bought into the fund at a price below $14.30, as it is essentially stating that EFC at this point is undervalued as a stock. Profits are up based on the rates we've seen as of late, which is something to keep in mind, as EFC might not remain as profitable if they start to be reduced. Although in saying this, it looks unlikely that the cost of money will be reduced anytime soon. EGY paid out $3.02, which puts the total income from this fund at $22.33. Bit of a side note, but interesting enough, the total combined income of all the monthly payers now nets the portfolio a guaranteed $15 per month. Although I won't be using it for it, this money could essentially now pay off my gym membership and Netflix subscriptions. ETY is supposedly still overvalued at $12.47. However, I believe that the $12.47 is a fair price, considering that their holdings of Microsoft, Apple, and Amazon are stocks which are all Asian US dollars plus in terms of share price. Not only that, but ETY offers a monthly dividend, which is something I'm happy to pay a bit extra for. The stock took a bit of a hit, dropping 5.9% for September. This dividend, however, remains consistent at 0.08 US cents per share, and they've already announced that this dividend will continue into October as well. FSK had another special dividend of $1.43, bringing the total to $57.64. The stock for 2023 has performed relatively well by increasing 12.51% in price. During September, however, we have seen it drop off slightly by 3.02%. For last quarter of 2023, FSK did manage to do something remarkable as far as financial performance goes, by being able to beat estimate earnings of 78 cents per share compared to 67 cents last year, despite having higher expenses, which in my mind proves their increased efficiency. The reason behind these increased earnings would have been from the higher rates they could have charged on the money loaned. With interest rates not decreasing anytime soon, we will continue to hopefully see them turn a profit for potentially most of 2024. They're still massively undervalued and are trading at a discount to their NAV. They have a healthy portfolio of first-line loans and a strong balance sheet with no debt maturities in 2023. And roughly $3 billion in liquidity. In my mind, it's an okay buy for those looking for a business development company. However, I prefer to invest in TSLX or CSWC just due to their solid performance as of late. Heartland Holdings paid the final dividend for the year of $81.92, which puts the total for the year to $145.55. This company is still undervalued by around 30% if we consider simply Wall Street's discount cash flow model to be true. Earnings have grown at a reasonably healthy rate of 7.9% each year for the past 5 years, which equates to around 7.5 million New Zealand dollars per year, which is about a 37% profit margin. The earnings for the next 5 years are expected to grow by potentially 10.44% per year, which I see as achievable based on their performance to date. The debt to equity ratio has increased from last year, which is something dividend investors should be wary about. This is as to start paying down more of their debt, they may decide to drop the dividend, just like they have in recent years, to pay off some of their debts. It's not a guaranteed move, but something I could see as being quite likely. Horizon paid another dividend, which was fixed at 11 US cents per share, resulting in 10.83 New Zealand dollars for the month of September. The total paid from this fund now sits at 87 New Zealand dollars and 79 cents. Horizon is an interesting one, as their past performance has been nothing but positive, and in my mind, it's still a great buy. However, this month, there have been a few minor alarm bells ringing for me regarding Horizon. According to Simply Wall Street, their 5-year shareholder returns have beaten the market by only 0.5% if dividends were reinvested, which isn't amazing by any standard, as the industry of business development companies has blown Horizon out of the wall by earning an additional 8.4%. They've managed to perform a bit better over the short term, but it's the long term we really care about. Analysts see them as slightly overvalued, which is probably due to their revenue being supposedly a lot lower than their business development company peers. When you look closer at this though, you'll see that this is in reference to their forecasted revenue, which is forecast to grow at 7.7% per year versus the market's expected 7.8% per year, which is nothing to be alarmed about in my mind, as this could change in an instant when the cost of money reduces. Their profit margins are also lower than last year by over 60%, going from 39.6% last year to 15.1% this year so far. Talking again about the value at the end of September, although they were down 3.02% over the course of the year, they are at the time of recording, they are at $12.25 US, which is $1.19 US off their 52-week high. They are also currently doubling the industry average on return on assets. It's worth keeping an eye on Horizon and just ensuring that their debt isn't increasing at a ludicrously high rate, as it's currently higher than their equity. This could indicate Horizon is struggling to pay off debt on the borrowed money it has been using to fund its investments as a BDC due to its recent spurt in rapid growth. Debt is usually needed to grow companies, as it's not all bad. It's just how they use that debt, which could be bad if they don't pay it down when they can, or make poor investment decisions which don't offer them greater returns than the cost of money. I won't sell, as I believe they will be able to pay down their debt, but I wouldn't be surprised if the dividend potentially takes a cut. JP Morgan paid out $1 New Zealand dollar and 35 New Zealand cents, bringing the total over 3 months to $5 New Zealand dollars and 61 cents. It's a small payout, but it's honest work, and it's something in hindsight that I wish I had heard of before purchasing ARK 3+ years ago. Although what ARK and JP invest in are very different, both aim to offer capital gains, with JP looking to have more of an onus on providing dividends, which is what my portfolio tries to prioritize. The fund has a negative 2.8% decrease in capital value over the month of September, which isn't great, as it was looking like about to reach its lowest point of the year thus far. I'm not worried incredibly about the month-to-month performance with this one. It's due to the S&P being a long hold stock that in turn makes this stock something to hold for long periods of time to increase your chances of returns too. JP is still paying their dividend and will continue to do so, which is all that matters in my mind. Microsoft paid 22 New Zealand cents, bringing the total to 64 New Zealand cents thus far for the year. I'm thinking more and more about relinquishing my position here and moving the money into funds such as ETY or BST, due to their major holding being Microsoft, which would then provide me with more income through increasing the monthly dividend of both those funds. My only thought though is, if in the unlikely circumstances Microsoft is sold out of BST and ETY, then I obviously won't have exposure to this company. In saying that though, if it was removed from BST's portfolio, it would be due to a financial decision regarding Microsoft's performance, so I probably wouldn't want to own it directly anyway. Therefore, in that case, it might work better to keep it in BST, which would provide me with more of an income than what Microsoft currently does. National Storage REIT paid 13 New Zealand dollars and 8 cents, bringing the total to 23 New Zealand dollars and 69 cents for the year thus far. This is one of my favourite companies due to their business model. I myself have always wanted to own some form of storage facility due to the low operating costs and high incomes they can generate from recurring weekly payments for long periods of time. National Storage REIT has had some impressive numbers over the past few years, which is why it's a stock I want to have more exposure to. The earnings have grown by 37% over the past year and look to grow by a further 17.7% on average each year after that. As you can see, since 2014, they have been able to recover from negative earnings and increase their revenue in an almost exponential fashion. They've also reduced their debt to equity ratio, which was about 64.8% in June 2019 to now 27.8% in June 2023, which is promising to see, as by doing so, they are bound to increase their earnings. They are still seen to be undervalued by 38.9%, which I see as fair due to their earnings looking to be finally on an up compared to their performances in 2014 and 2020. Dividends seem to be increasing at a steady rate, which isn't outpacing their growth either. It's not all sunshine and rainbows though for stock, as their return on equity is a bit lower than the industry standard, and their operating cash flow doesn't seem to be covering their debt well. Their short-term assets seem to not cover their short-term liabilities either, so this does have the ability to hurt their income, as they may have to increase their debt to equity ratio to grow the business. I'll still invest and try to keep a close eye on if their operating cash flow increases and provides more security around their debt that they owe. The New Zealand Bond Fund paid out $4.36, bringing the total to $12.66 for the year. Bonds and interest rates usually have an inverse relationship, so if interest rates rise, the bond market drops. With interest rates on the rise around the world, including New Zealand, the New Zealand Bond Fund has not performed as well as one might hope. I still enjoy having a hand in fixed income markets, especially with something relatively low risk such as bonds, and therefore not too gutted about their performance to date, as is to be expected with the market cycles. I'll continue to put small amounts of income into this fund. However, most of my fixed income comes from high interest saving accounts such as Squirrel, which usually net me $100 per month. Prospect Capital Corp paid out $19.03, bringing the total to $160.35, making it the third highest paying stock after ABR and IFN. The stock's price was all over the show during September, reaching highs of $6.25 and lows of $5.96 to ultimately finish with the month started around $6 per share. At the time of recording, we are now down 17.06%, which is a bit concerning. Part of me wants to roll the dice and try buy up a decent portion of this, as it's the lowest price it's been since its COVID price of $3.78. However, I think that it's been trending in a downward direction for the past few months. It probably has a few more percent to fall before it's worth a buy. There's nothing inherently wrong with this BDC, apart from a few minor red flags, if I were to call them that. The positives, as I've said before, is that 56.5% of their investments are first line, which provides investors with a bit of added security. They've also surpassed earnings reports by beating estimates by 9.52% for the quarter just been. After reading their latest quarterly report, it states that their net asset value is also at $9.24 per common share in June. So even if you decided to buy the stock now instead of waiting for a cheaper moment, you'd essentially be buying it at a discount. Where there is a bit of worry is that their negative earnings per share will continue to trend downwards for the next few years. Once you're on a profitable portion of time, it becomes harder and harder for a company to regain profits. I'm confident though that we will see profits, as the team has stated that they have maintained low leverage positions on purpose to capitalize on opportunities in the secondary market when they arise. As one of America's most successful BDCs, and their wide spread of investments in a multitude of sectors give them a bit of added protection in all of market conditions compared to BDCs that invest in only a few sectors. QRD paid two dividends, one lagging from August, which brought the total to $5.71, and the total paid for the year to $27.28. Nothing major happened with this investment over the months of September. It's just nice to see that a dividend has continued to come in. Starbolt Carriers paid out $8.53, bringing the total to $27.13. They've had a bit of a rally as of recent times by gaining 12.3% over the past 4 weeks. This probably came from the continued stress on grains and fertilizer shortages from the Ukraine war and climate change, allowing SPLK to charge a premium when shipping grain due to low supply in the market. Analysts believe that SPLK is potentially still 50% undervalued and can reach a price of around $25. This is great and they could get there, but at this point it's tough to say that, since their earnings have dropped off immensely since their boom brought about by the COVID market. Their dividend has also dropped off hugely since their high profit era, and is yet to reach a stable point which will be somewhat consistent due to their dividend not currently being well covered by cash flows. It also doesn't look the best for SPLK, with their co-CFO selling 23,000 shares and their president selling 48,000 shares, as it indicates a lack of faith in the company's performance. Although it's not inherently bad, the debt makes this investment more risky than usual too, especially as their earnings before interest and tax dropped 67% in the last 12 months. If declines like this continue, their repayments will become more and more difficult to repay. I'll continue to hold the stock until I see positive signs of their ability to keep their earnings before interest slightly more consistent, which will give me a bit more confidence in other areas of the business. SkyCity paid out $50 New Zealand dollars and 41 cents, bringing the total to $30 New Zealand dollars and 46 cents. Not my favorite stock, but still one that I'm confident should be able to provide profits to my portfolio in the near future. Since COVID, the stock has been battling to make a profit, even after they released the ability for patrons to continue to gamble online, which is one of the major incomes other than cinemas, hotels, conventions, and hospitality areas that part of the business runs. As I said, they've managed to start to increase profits this year and are forecast to have their earnings grow 22.19% year on year. Other positives are that back in August, SkyCity's director bought a further $159,000 worth of shares, which was one of the largest purchases by an insider in the last 3 months, and provokes confidence in the company's ability to perform. Their dividend isn't currently covered by earnings, so I wouldn't be surprised if their dividend takes a big cut. Regardless of that though, their forecasted profits look to be achievable, which is why I'll continue to buy more of this stock while it's undervalued. Keep in mind that prior to COVID, they are performing relatively strong. Since the market has essentially passed that uncertainty, minus the inflation and interest rates we're currently experiencing, I think we can expect for them to bounce back quite strong. Stride Property Group paid out $1 New Zealand dollar and 36 cents, which brings the total to $5 New Zealand dollars and 26 cents and 27 cents. Nothing of interest to note this time around for the holding. STAG paid out another dividend of $3 New Zealand dollars and 86 cents, now bringing the total to $33 New Zealand dollars and 16 cents. The dividend percentage payout is responsible and doesn't overbear the company's finances by allowing them to retain enough to grow the business. Their current debt is quite high, but I believe by retaining the amount of earnings that they should have no issue continuing to reduce their debt where they can. Understand that for rapid growth, this company most likely needs to take on more debt to be able to purchase properties, then lease them out to industrial tenants. The larger the portfolio, the bigger profits. This has been shown by them being able to grow revenue by 15% over the past 3 years, and then having earnings per share grow by 5.5%. However, with one of the directors selling out of the stock, it's a bit concerning and prompts a question as to what's really going on, especially since company insiders have sold more than 3.8 million more in shares than what they initially bought. It could just be due to the fact that they've seen it as a more profitable move than buying and holding, but it's hard to say without being able to talk to them directly. As we haven't seen a sale of shares across the board, I wouldn't consider this necessarily bad. However, I will keep an eye on it in case others from the management team follow suit, especially as forecasts state that we might see a 25% reduction in the earnings from STAG. Not something that I'm eager to buy more of, but more something to hold and continue to experience the consistent dividend. TSLX paid out a special dividend of 69 New Zealand cents, bringing the total to 11 New Zealand dollars and 50 cents. Again, nothing interesting to note this month with this holding. Our final payment came from Woolworths, who paid out a small dividend of $1 New Zealand dollar and 89 cents, bringing the total to $3 New Zealand dollars and 38 cents. For those who don't know about Woolworths, it's an Australian and New Zealand food conglomerate that owns supermarkets throughout both countries. Their dividends haven't been as consistent as one would hope, from moving from 48 Australian dollars back down to 39 Australian dollars and then to 58 Australian dollars within a 3-year period. This company is slow moving due to its massive size, and it doesn't have much growth left in it. For instance, it's only grown 0.9% year over year for the past 5 years, which is not much for a company of its size. It is good to see, however, that the return on capital employed is 3.5% higher than 3 years ago, and indicates that the company is heading in the right direction. If we look at its shareholder returns, we can see that it's trounced the rest of the market year over year for the past 5 years. Food is a necessity that everyone will continue to pay for, even if it does continue to become more expensive, which is why I'll continue to invest in Woolworths. It's great to see that this month brought us back on target to earn 2,400 New Zealand dollars in dividends for the year of 2023. It's not a big goal, but it will indicate a 40% increase from last year's total dividend income. After earning 275 New Zealand dollars and 87 cents this month, we've officially just surpassed our total income for the last year by 0.17%. And I still have 3 months left of payments to net, so therefore I'm sure we can average 225 New Zealand dollars per month to get to the goal. At the end of September, we're up about 0.42% in terms of our capital value. The total portfolio yield was a bit higher and grew to 5.61%, but it still sits under the 7% threshold we have on the portfolio, so I'm happy with that. This quarter we've done reasonably well, which is something I'll touch on in a later video. Looking forward to what October brings as we start to enter the final quarter, 2023.